because if you don't make it affordable, even in the United States, if we can't afford for our youth, our generation to have housing or just go out and start on their own, what good is it? All that job, what good is that country is going to do? Because we're going to lose a lot of youth is actually traveling to Southeast Asia and different part of the world working remotely because they can't afford to live here.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today my guest is Nick Khamsopa. Nick Khamsopa is the CEO of Hudson Housing Lifestyle, building workforce communities across the Hudson Valley where working families truly belong. And in just a minute, we're going to speak with Nick Khamsopa about the affordable housing crisis. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Nick Khamsopa. Welcome to CREPN Radio.
Well, thank you, Don, for having me. I really appreciate it. Excited to be on the show today.
Well, I'm delighted you're here, and I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah. My background is construction. For the love of construction since I was 5. When I started construction at a young age with my neighbor sweeping the floor in high-rise Manhattan, and all we wanted to learn how to build one of these mega building, I call it. So I went to a trade school, vocational school for 2 years. When I graduated, got accepted into the union for 5-year apprenticeship working in Manhattan. That's truly where I learned it. When I graduated, I started my own union contracting, had close to 100 union men working for me up and down the coast, outfitting retails, interior, exterior finish, along with being the general contractor to outfit two-to-time daycare, got kindergarten in the early 2000s, and the money I made, I bought up some land and developed land and learned land entitlement and understand how to do custom build from custom home to commercial building. And my passion is always construction, but what led me to become a developer is that I realized there's actually, more profit. Why don't I just build for myself instead of building for somebody else? And that's how we are where we are today.
Got it. So currently you develop and build and hold your own inventory, is that correct?
Yes. So right now, basing on the mission statement of Governor Hochul, she launched an executive order to build 1 million unit in New York State affordability. And April 2025, we passed legislation for 800,000 units to be built throughout New York. And approximately 160,000 units already built. So I'm spearheading along the Hudson Valley north of Westchester to Albany, to go from village to village to find a location that is pre-existing dilapidated building, or a brownfield that we can pick them up basing on the government mission statement to rezone and upzone to assist with the parking. And since this building already have water, sewer, electricity, it's much easier for entitlement. So all we have to do is just get the upgrade basing on the program. New York has launched a $25 billion subsidy to assist developer. What I meant by that, affordability or affordable housing is not like a Section 8. Most people think when they hear affordable. I mean, these are market rate. Why is a market rate have to be affordable? If you do not have the subsidy from the government or the federal or local to support this project, the cost of building this type of facility is between 450 to $500 per square feet, 1,000 square feet, 2 bedroom. We're talking about 500,000 times 100 unit is 50 million. That means most builders with that kind of mortgage, we have to charge an average of 5,000 to 6,000 a month just to pay for the interest rate, interest can cost to build without, the tax and other service contract. So it doesn't pencil. But if the government do LIHTC financing tax credit of the federal with the New York State capital stack, that allow us to de-risk to build this project at 50% or 60%, on cost of construction. So therefore, if we do take the grant money, we have to charge an average median income of the county rent roll. So my county, for instance, would be $25,000 a month. For me to maintain $25,000 a month, we run the number with the construction management company and the bank to make sure the project doing the pre-development pencil before we close on the construction loan.
Got it. There's lots unpacked in what you were just talking about there. So the affordable housing is a crisis. I mean, clearly it's about, it just costs too much. I mean, people aren't able to buy or even rent based on a traditional standard with just a one job. We were talking about before we started recording about the need to have 3 jobs just to meet your basic needs. And what if I understood what you were kind of going through there, the solution, or one of the offered solutions, is I don't want to say an assistance, but some sort of whether it be tax credits or whatever, but it's the upfront in the development versus on the back end paying the tenant's rent. Is that kind of the difference there? Because I think what Section 8 is basically paying the tenant's rent versus was it low tech or low income, low income housing, tax credit, yeah, is basically a mechanism where the federal government provides tax credits for housing to the states based on need, and then if you're a developer and you have a project, you can that's where I get a little confused, is who gets the tax credits, because I know ultimately they go to the lender, right, that gets to offset their tax bill. And tax credits are certainly much more valuable than a write-off. I mean, it's not an expense. It's a you taxes owed equal tax credit. You can pay your taxes with a tax credit, essentially.
Okay, yeah. The question you're asking, I think, is LIHTC. There's a program called LIHTC, LITCH. Anyone can Google and understand what that is. They have 4% and 9%.
Right.
So the LIHTC financing is a 1031 exchange, right? Let's talk about the Fortune 50. Well, you got these big corporations, or you inherited, couple $1 million in the real estate, or you bought something, so you made a couple million. So you have to pay capital gain on it. So there's a program through LIHTC financing. You actually give money to these financial institution or financial service that take your money and then give me the loan. So by giving me the loan, I'm paying you 6% on that money. So therefore, after 15 years, I refinance, pay you back, or basing on the underwriting, quite a 10 or 15 year, depending on how we structure that. So that, say you have $1 million, you put into this pool, and then I use that pool of money, I pay you 6%, and then after 10 years, we refinance, I pay you back. So you don't pay that capital. So this is structure that, believe it or not, there are trillions of dollars in this portfolio. And when you hear President Trump came in and say, I'm extending LIHTC financing for affordable housing or to help with the housing, this LIHTC is for the super rich corporation or super rich individual. Don't pay any taxes. Now the money, instead of paying the tax, go back into this type of development. And it's actually help expand economic further than paying the taxes, right? It's a win-win for a developer like me, win for the people who put the capital into place. We have to qualify for that to apply to get that. And that LIHTC is the base of the funding mechanism. And then you get the capital stack of the locals and the state help with the grant. The New York State launched a $25 billion capital for affordable housing structure. That $25 billion is to expand the infrastructure, to expand the sewer, expand the water in preparation to assist developer for this housing, because New York is losing too many talented to low states.
Got it. So just to be more concrete, if we could, let's pick a project, and I don't know, how many units would you expect to build in any one of your projects, in one of these
So yeah,
projects?
I'm developing a prototypical of a minimum 100 units
Okay.
per
So in
location.
100, yep.
Right.
So in 100 unit development, in the capital stack, or not even the capital stack, let's just talk about the construction budget to build 100 units. What would you expect that to look like?
About 50 million.
50 million?
Right.
All right. So 50 million to build it, and that includes land?
Yeah, let's say
Okay.
all in 50
All in.
million
Okay.
with everything. Yeah.
So 50 million, and in a traditional build situation, how much would you have to have down to make that for a lender to lend you the money to build that?
Something like this, you need 40%.
40%?
Yeah, that's
So,
where the rest is. Yeah.
so you're gonna have to come up with 20 million. That's gonna be the equity that you're gonna have to have in order to get the loan for the 30 million, right?
Correct.
Okay. So in a in this situation we're talking about now, where you have the low income housing tax credits and you have the grants from New York, et cetera, tell me how the numbers look, because it's still a $50 million project, right?
You can get up to 40% from LIHTC.
Okay.
Between 20, based on the qualification, about 20% from the New York State Momentum Fund. And then you have the local IDA that give you tax credit for non-paying tax on the product, right? Because local IDA want to have economic in their town or their city or their county. And then you have other tax credit, which is the tax credit from the town or the municipality may want to partner with you on these portfolios to become, dividends. So there's actually one being built right now in Arsenal, and they secure up to 95% of the capital pretty much for free. Not free, but you're going to pay this back. What I'm saying. So the de-risk on this, the mitigating the risk factor is the construction financing of it. But also, it's not just construction. You have to underwrite it to where how you going to de-risk it from the insurance purposes. Who is going to guarantee the project to turnkey this? Who is going to bond to guarantee turnkey for the bank to fill secure for the to come on board to underwrite alongside the developer to make sure the project is success. So we underwrite it under HUD guideline. HUD is a AAA underwriting guarantee to make sure we can de-risk and insurance to insure each segment of development.
So does HUD also then do they make the loan on it, or are they? Because I know that there are some HUD programs for lending. Is that
But this is not HUD program.
okay? Okay.
Another thing that HUD also got HUD from President Trump is HUD is not as strong. The HUD guideline to ensure to FedBay and FedMac for this type of portfolio was the strongest underwriting criteria. But right now, the new mechanism is LIHTC financing with the New York State Momentum Fund. And the reason that Momentum Fund is in place is her mission to put this 800,000 unit to capture, to assist the workforce housing that is in demand for the growth of New York economic.
Got it. So we the net on this on the construction, the comparison is if you're going to build it just traditional market rate, you're going to, as the developer, you're going to have 20% of your own in this versus if you go through the affordable housing route, you're going to have 5% essentially, just rough numbers for comparison. Now the question,
no developer would do that to put up 40% of their own money and then trying to do affordable housing. They're gonna
yeah. No. I mean, it's just it. It's a non-starter, right?
Yep.
There's no possibility for return there. So now my question, just for clarification. So what are the obligations once the project's in place? I mean, what do those grants and the LIHTC financing, how do those look like for obligations of the operator of the property?
The operator, you mean the sponsor of the property, the sponsor, a developer, is we have to have the comprehensive underwriting team that costs about $2 million to put that together for the closing of this construction loan to underwrite with the proper team. And while you're underwriting as a developer, you have to have construction bank from day one. So you partner with a construction bank, which we have, and construction bank will underwrite the construction along with the triangle construction bank, construction contracting or general contracting that can bond to guarantee the product, along with the construction services bank. So the three have to be a triangle. Doing the pre-development that take 5 to 6 months to come up with a fixed budget. The construction company is invited to create the budget. It's not like you come up with the money and you send this out for bid. The bid have to the budget have to fit basing on a fixed budget of what the AMI is and what the bank can loan, and then there is a shortfall. We put the application in from the state and local to come up with the capital. So that 6 months of underwriting is how you de-risk the project to guarantee turnkey. At the closing of construction, the construction general contracting that they're actually being invited to pay the budget along with the developer and the bank already know all the numbers. He already pre-sold his job before we closed on the construction loan. So this is an invitation at the highest level. It's very complicated, but the risk factor from what I'm talking about is actually a lot easier because most people do not get involved in this type of development because you have to have tremendous amount of knowledge, not just in construction, in development, but also knowledge in financing.
Right. No, I get all that. And what I was trying to do just for a little simple side-by-side comparison, $50 million is what it's going to cost to build 100 units, period, whether we go this way or that way. The traditional build, just a market rate build, I guess the question is how do the rents compare? Because obviously what I was trying to understand was what are the obligations of the sponsor, the operator. I mean, once you have a finished product, is there not some sort of a commitment that you have to commit to keep this product, this this housing project in the affordable space for X amount of years so that the people this was designed for can live there, or is that not the case? Or is it
Okay,
just
I understand what you're saying. I misunstood.
or is that a
So
just a
no, what happened is
market rate product?
yeah, AMI mean average medium income for the
Right,
county, right?
right.
So if I were to take this grant money, I cannot charge my county, I believe, 2,400 or 2,500, somewhere in that price range.
That's
The
that number represents what? The current?
two-bedroom rental unit, I cannot charge above it.
Okay.
I have to maintain that.
Okay.
I'm getting all this grant money. I have to maintain my integrity. I mean,
Right. Right.
it's not right, right? The one bedroom is $1,700 a month. Now it become affordable for for the young police officer, for young nurses, for the young carpenter, for the young um, attorney who came out of college. They can live here and build a life here. That is affordable housing, not low income voucher, not Section 8 housing. So let me make that clear. This is built for the workforce, for the local average people who want to live there.
And there the again the commitment or the obligation of the sponsor is that you will keep it affordable for how long? How long does that have
For
to
lifetime.
for lifetime? Okay, so the
Yeah,
project the project there's not like a sunset. This is a lifetime of the project.
correct.
Okay. And the reason why that works as opposed to charging what would be a market rent, what if we built this same project and we were going just market rent, what kind of rents would you have to charge?
Uh, for that type, at least 5,000 to 6,000 a month.
Okay, so there's that's the I mean that right there, that's the number that people can you can start to understand. You're talking about a 50% rent decrease and the only way that that works is if you have some significant offset in the financing to where you don't have to service such a high debt number, correct? I mean, that's basically what we're talking about. It's about the debt service at the end of the day.
Correct.
So, and so now instead of having a in the market rate model, we talked about, if it's a $50 million build and you're coming in with 20, you're gonna have a $30 million mortgage, or I assume do these construction loans, do they go from construction to permanent, or do you refi once the project's done?
That's a great question. So the structure I have put in place is actually been doing it for 3+ year. Is I went to my union relationship to AFL-CIO. They have a division called Housing Investment Trust out of Washington, D.C. And Housing Investment Trust using union pension fund to invest in a permanent mortgage for this type of portfolio. So they love housing because this type of housing, even though with development without HUD, like I stated, I'm underwriting the project as HUD guideline. HUD guideline is a AAA rated asset. So the construction bank, the funding bank, is the one that have relationship with these, head housing investment trust using the pension fund money to purchase the permanent 40-year debts. So I went to see them first and I asked them, what bank do you want to work with? Or you recommend I work with, or we work with, and they recommended Merchant Bank, a Midwest bank out of Chicago area. I interviewed 3 banks from them, and the one I like the best is Merchant Bank to fund this construction loan because they have a mechanism, insurance in place when this project is completed. From your standard, is insured in the form of Jenny Mac paper, and they sell that paper to AFL-CIO pension fund to purchase the debt for 40 years. So my senior debt is taken out, so I can come back to my construction bank. And then I took the construction bank and went back to the local municipality and the Hudson Valley Momentum Fund. Say, I have these in place so I can underwrite the capital stack to assist with the bank to fund the construction loan. So I think I should have mentioned that to you first, because that's what the insurance segment is. And so each segment is insured, right? The construction company will insure posting a performance bond to guarantee turnkey operation for the bank to give a construction loan, and the bank, when the construction completed, underwriting the insurance to exit, selling the insurer or 40-year note in the form of U.S. Treasury.
Got it. Got it. Yeah, when you get into these, and it's not public housing, but like you're saying, all of the financing stack there is looking for assurances that this is going to be completed, and that would necessitate, performance bonding to meet, so that they would know that they're going to be made whole should it not happen. That makes sense. So in these projects, so let me ask you, how many of these have you built that you are currently operating yourself, or have you, or is this more of where you're going?
I've been doing this for 3 years now, three
Okay.
plus years. So we're not looking to build one. We're looking to build 50 locations using the structure, because remember, she passed legislation to build 800,000 units. Out of the 800,000 units, the big boys already built 160,000 plus units. I'm only building 5,000 of the 800,000 units using the same structure they're doing. But I didn't come from money. My father and my mother didn't have a big bank account, so I have to raise the capital, and implementing this, utilizing my relationship in the Hudson Valley to put the exit in place first before I engage in the implementation. So we have 5 locations in engagement to do pre-development. So I just got a commitment in from from the CapEx that is raising $100 million for me to expand out 20 locations, because it takes 6 to 9 months to secure the grant. But however, you need the money now. So you have to leverage that with the investment banking group and say, listen, I need this X to span out the 20 locations. So this way we can launch now, not wait another 4 or 5 years, or I can never do this at a large scale. And I don't think I'm doing large scale at 5,000 units to the 800,000 that been mandated by the state of New York.
So I'm curious, do you already have the 5 locations locked up?
Yes.
Okay. So I would think that's kind of the first step whenever you're talking to anybody, that you've got the location, you've got the model, you've got the finance stack. And because you're already in these conversations, I would think, is it not easier to get additional projects approved, knowing that you're already in front of all the right people, that I mean, as opposed to coming in as just doing one and then starting all over again? I would think that having 5 would be an easier. I mean, if you're in the door already having a conversation and they know you have 4 more, is that not an easier path, knowing that they're going to get 5,000 of the 800,000 units they're looking for?
But the good thing about this housing, we're going into the village or the city. That's it. One good thing about where we are in the Long Hudson Valley, the poor housing, right? And this is not built like a vinyl siding and simple. We're taking a pre-existing abandoned warehouse back in the Industrial Revolution. All these towns built around this factory and this abandoned warehouse. Now this abandoned warehouse become an eyesore in the middle of the village. So we're taking that brick Art Deco, design it to retrofit the interior, and restructure it with the structure engineer, and then make it like sexy, integrated with the village. So the village want to uplift and see that building being redesigned for housing. So these properties actually under a economic zone for redevelopment under poor housing community. So none of these planning board want to shoot that down, because we're not doing, once again, as much as we need Section 8 housing, we're not building Section 8 housing. We're building a market rate, a building that generate economic for the local community for them to, to be integrated with the village.
Got it. So just to clarify, you're not going to demo an existing structure. You're going to retro, or I mean, renovate an existing structure. Is that your strategy?
Yeah,
Okay.
this we call brownfield revitalization, right?
Right.
So
Right.
a lot of this building went through many hands. So a lot of these building were purchasing pretty high price because they already went through the Clean Bill of Health, EPA, clean up. Some of the building that, because it doesn't have it, like for instance, we have one in Westchester that the existing developer kind of leveled the building and the grounds there. So we're just taking where the ground is and took where he took it to halfway entitlement, and we took him from his halfway entitlement to finish it to the finish yards line. So using our capital structure to implement it. So the hardest thing was putting the capital structure in place before I engage in the location, because if you go into engage a location and looking for capital, the most you're going to be able to scale is one, two project at once. I have 4-year mission statement, 5 years to exit these to assist with the 50 location of only 5,000 units.
Got it. So you are looking to build 5,000 units in, would you say 5 years? Is that the?
Yes. That's why we
Okay.
decided to go with union built. I'm a union guy,
Okay.
using union pension fund to keep the circular economy of local construction, local union and union wage. So this way money stay within locally. It's sustainable, not just in housing, but financing too.
Sure. And I would think that, like you mentioned, the the local communities are probably excited to see the big ugly building that's been a kind of a staple in their community become kind of the new shining star and become a part again a center of their community as opposed to that the eyesore kind of thing. Is that, I mean, are you getting some buy-in from the local community too?
So what, like I said, I didn't invented it. I'm just taking what is existing and then, assisting development. If you look along the Hudson Valley, north of Manhattan, 1 hour north of Manhattan, a lot of these small towns been cleaned up. You go into this beautiful, I call like Brooklyn vibe of Art Deco. One time it was like an old abandoned mill, a warehouse as I saw. You go by it now, it's the sex appeal peak. No, I'm sorry, Beacon,
Yeah.
New York. You go to Beacon, New York's a perfect example, prototypical of how this house been rebuilt in the last 10 years. It's beautiful.
Yeah.
Yeah.
No, I think the renovation of a historic, kind of a industrial building made in housing, it's can be very attractive. That's exciting. I wish you well with all that. And I think the housing conversation is a challenging one, but like what we talked about before we started recording is, and maybe we're talking about a little bit in this conversation too, is just the need for some affordable housing so that you're not losing all of your talent, your local talent going somewhere, far away when you have a vibrant economy that needs workers, right? I mean, you're talking about all the jobs in the Hudson Valley there and the need for employees. If you don't have housing that's affordable, uh, we're I mean, it's a definite, it's a part of the puzzle that has to be solved. And hopefully this is a good solid cornerstone to that solution, and keeping the talent and continuing. So sounds good.
Yeah, yeah. I'm glad the governor implemented, and I'm very happy for her to really assist in New York, because New York just lost the rating of the population to the state of Florida. Florida now is the third largest population state in the United States. And if we don't do something, New York will collapse. So I see this as major economic. It's not just about launching the capital to assist the developer, because if you don't make it affordable, even in the United States, if we can't afford for our youth, our generation to have housing or just go out and start on their own, what good is it? All that job, what good is that country is going to do? Because we're going to lose a lot of the youth is actually traveling to Southeast Asia and different part of the world, working remotely because they can't afford to live here. I was speaking to a kid who moved from this part of the town. He's living in Texas, where he can buy a townhouse over there for 180,000. You can't touch a townhouse here in this area for 450,000. So you can see the cost factor, and if we don't do anything about it, it's to me it's national security, I call it.
Yeah. No, it's a conversation that needs to be invested in, and the topic and the solution needs to be invested in, and we need to kind of right size that and you know because losing talent is not good for any community that's looking to go forward and
Right. Yeah.
stay on the map there. So got it. Hey, Nick, if we could, I'd like to shift gears here for a second. As I mentioned to you before, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. It could be your financing, could be the local government, could be the market rate tenants or market rate, rent, whatever it is that you identify and consider to be the biggest risk. And again, for a clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Nick Khamsopa, what is the biggest risk?
Biggest risk on this is the seed capital, because the seed capital that we need to pay from acquiring the property from 3 million or 30,000 per unit, we need to spend that $2.5 to $3 million to entitle it. When it's fully entitled, we gain approximately $6 to $8 million per location equity. So we went from 30,000 to 120,000 per unit. When it's times 100 units, we're talking about 12 million. So the biggest risk is to explain it to an accredited investor, saying that we need help procuring the capital to tie or secure this land so we can engage in pre-development and underwriting the grant right away, because it takes 6 to 9 months for that grant and the capital to come in from the bank for the construction bank to close on the loan.
Yeah. No, the seed capital is definitely a big part of what you do there. I get it. Hey, Nick, where can the listeners go if they'd like to learn more or connect with you?
We can go to our website, www.hudson lifestyle, hudsonlifestyle.com. So we want to brand this as we move forward, because we love our portfolio so much that we want people to live like a lifestyle, not car and apartment, because we want to build these and integrate it with coffee shop, small eatery on the first floor. So this way is the way of living, not building this outside the town. We want to build it within walking distance to a bus stop or train stop, to integrate that as a walkable community for the new generation.
Oh, that's good. Well, Nick Khamsopa, I can't say thanks enough for taking the time to talk. I've enjoyed it. I've learned a lot, and look forward to doing it again soon.
Yeah, thanks for having me. I greatly appreciate it.
All right. For our listeners, If you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.